Hello, I am Kalan Kabalonga and I will be the first presenter for the discussion of the expenditure cycle. Well, in every business that may be a profit or non-profit based, incurs expenditures in exchange for resources, provides value added through its products or services, and receives revenue from outside sources. Such events refer to the three cycle that is subdivided under the transaction processing system, which processes financial transactions. We have the expenditure cycle, conversion cycle, and the revenue cycle. As for the expenditure cycle, this is concerned with the purchases, the expenses. You will see later on under expenditure cycle, our subsystems are purchasing, cash disbursement, and even your payroll and fixed assets. It is more of a cash outflow and acquisition of goods and services. And the relationship of these three cycles can be described from purchasing materials pertaining to an outflow of cash that is converted to finished goods and that is to be sold to the customer pertaining to an inflow of cash. That is why an expenditure cycle is seen to be a counterpoint to revenue cycle. And there are two parts of expenditure transactions, the physical component, which refers to the acquisition of goods, and the financial component referring to the cash disbursement to the supplier. These two parts justifies the fact that in most expenditure transactions, there is a credit relationship between the trading parties since purchases are not usually through cash payment but a purchase on account, in which the actual cash disbursement will be followed by then after the receipt of the goods and services. Now, the objective of the expenditure cycle is to convert the organization's cash into the physical materials and the human resources it needs to conduct business. Primarily, it is to minimize the total cost of acquiring and maintaining inventory, supplies, and services, but not limited to such. It is also to ensure that all goods and services are ordered as needed, and invoices are valid and correct, and the goods are received in good condition and safeguarded until needed. And it also ensures that all cash disbursements are related to authorized expenditures and recorded and classify it accurately. So here are the two major subsystems. We have purchases processing and cash disbursement subsystem. First, under the purchase processing, it is categorized into four different procedures, also known the purchasing cycle. It involves the identifying inventory needs, placing the order, receiving the inventory, and recognizing liability. So first, an entity needs to monitor its inventories because at certain point in time, when the inventory level is below the level of reorder point or met the threshold when it is necessary to order, an entity needs to place an order. And from this point, if expenditure cycle is on the part of the purchaser, the supplier needs to perform its revenue cycle, where it provides certain orders or services. And then once the inventory is received, the legal responsibility or financial obligation arises. Thus, the entity should recognize the liability. So you will notice that the primary external exchange of information under this cycle is with suppliers. Well, take note that the information can flow either from other cycles to the expenditure cycle or from the expenditure cycle to other cycles. We have here the data flow purchase process. Take note of the purchasing cycle mentioned earlier. So under the data flow diagram of purchase process, first we have the inventory control or the monitoring of inventory records. Here, the purchase process begins with the need to purchase, wherein if it is a merchandising firm, it is the purchase of finished goods for resale under inventory control function. And if it is a manufacturing firm, it is the purchase of raw material for production under the production planning and control function. So for the monitoring part, you simply check your inventory if it's still sufficient enough. And if it reaches the level of reordering point, a purchase requisition is prepared and sent to the prepare purchase order function to initiate the purchase process. Consequently, prepare purchase order. This is when the purchase order is prepared or approved. A copy is sent to supplier that may be through physical document or most commonly through electronic document. And then a copy is also sent to the setup accounts payable function and is temporarily in the AP pending file for later monitoring. And then a blind copy is also sent to receive goods function where it is held until the inventories arrive. When we say blind copy, it is without the price and quantity. It is for control measures because the personnel in the receiving function should count the actual received purchases rather than just depending on a copy of purchase order. Lastly, the last copy is sent to open and close purchase order file.
Hi, good day to all of you. I'm Stephanie Olivar, your second presenter. To continue the discussion about purchases processing procedures, the third procedure will be receive goods. Usually between purchase order and receiving goods, most businesses experience a time lag. In this third procedure, the copies of the purchase order will be reconciled in various departments. Remember that no economic event has yet occurred. The company has not yet received any inventories or incurred any financial obligations. As a result, there is no basis for establishing a formal accounting entry. However, firms usually make memo entries. The receipt of inventory is the next step, so goods arriving from the vendor are reconciled with a blind copy of the purchase order. As you can see in Figure 5-4, which is an example of blind copy purchase order, it contains no information regarding the amount or price of the things being received. The blind copy's objective is to make the receiving clerk count and inspect the inventory before completing the receiving report. Why? Because receiving clerks may be inclined to accept deliveries based solely on amount information rather than verifying the number and quality of the products if just quantity information is provided. The blind copy is an important device in reducing this exposure. Upon completion of the physical count and inspection, the receiving clerk prepares a receiving report, stating the quantity and condition of the inventories. An example of receiving report is shown in Figure 5-5. The physical inventories are delivered with one copy of the receiving report to either the raw material storeroom or the finished goods warehouse for safekeeping. To complete the purchase order, another copy is filed in the open or closed purchase order file. The receiving report is submitted a third time to the accounts payable department where it is filed in account payable pending file. Inventory control receives a fourth copy of the receiving report in order to update the inventory records. Finally, the receiving report is copied and placed in the receiving report file. So the fourth procedure is update inventory records. Inventory control techniques may differ slightly among companies depending on the inventory valuation method used. Organizations that adopt a standard cost method keep their inventory at a predetermined standard value. Only information about the quantities received is needed. Meanwhile, in the actual cost inventory ledger, additional financial information such as copy of the supplier's invoice when it arrives is required to update it. The next and fifth procedure is set up accounts payable. During the course of this transaction, the set up accounts payable function has received and temporarily filed copies of the purchase order and receiving report. The organization has received inventories from the vendor and has realized a payment obligation. But at this stage in the process, the company has yet to receive the supplier's invoice too, which contains the financial data required to register the transaction. As a result, the firm will wait until the invoice arrives before recognizing the liability. This regular occurrence causes a brief pause in the recording process. The accountant will have to estimate the worth of the obligation until the invoice arrives in order to close the books. An adjustment entry must be made to fix the error if the estimate is materially inaccurate. because invoice receipt usually initiates account payable procedures. When the invoice arrives, the account payable clerk reconciles the financial information with the receiving report and purchase order in the pending file. This is known as a three-way match, and it ensures that what was ordered was delivered and that the price was reasonable. The transaction is recorded in the purchasing journal and posted to the supplier's account in the account payable subsidiary ledger once the reconciliation is complete. Remember that the inventory valuation method will determine how inventory control records inventory receipts. The account payable clerk would transmit a copy of the supplier's invoice to inventory control if the company uses the actual cost approach. This step is not required if the standard costing is utilized. The account payable clerk transfers all source papers to the open account payable file after recording the liability. This file is often categorized by payment due date and examined on a regular basis to ensure that debts are paid as soon as possible without missing due dates or losing discounts. Later in this part, we'll look at cash disbursement procedures. Finally, the account payable clerk sums up the purchasing journal entries for the period and creates journal voucher for the general ledger function. Furthermore, many businesses employed vouchers payable system instead of the account payable procedures mentioned in the previous section. So after the three-way match is completed, the account payable clerk creates a cash disbursement voucher to approve payment. Vouchers increase cash disbursement control by allowing businesses to aggregate many payments to the same supplier onto a single voucher, minimizing the number of the checks issued. So the voucher register reflects the company's liabilities, though the total account payable is the sum of the unpaid vouchers in the register. The cash disbursement voucher along with the supporting source documentation is filed in the vouchers payable filed by the account payable clerk. This file is similar to the previously stated open account payable file and is likewise organized by due date. Lastly, the sixth procedure is post to general ledger. The account payable department sends a journal voucher to the general ledger, and inventory control sends an account summary. The general ledger function reconciles the inventory control account and the inventory subsidiary summary by posting journal vouchers to the inventory and account payable control accounts. The journal vouchers that have been approved are subsequently saved in the journal voucher file. So, the expenditure cycle's purchases phase is concluded with this step.
Hello, my name is Jessa Bakuboko. The cash disbursement system. It handles payment for obligations generated in the purchasing system and to ensure that when the obligation is due, valid creditors receive the correct amounts owed to them. DFD for cash disbursement system. The accounts payable process examines the accounts payable file for overdue items and permits payments to be made through the cash distribution procedure. The cash disbursement process is responsible for preparing and distributing check to vendors. Both the cash disbursement accounts and the accounts payable processes provide summary information to the general ledger at the conclusion of the period. Identify liabilities due. It starts the cash disbursement process by identifying things that have become due, like the AP function looks for such items in the open AP file or vouchers payable file. It also transmits payment permission to the cash disbursement department in the form of a voucher packet, voucher, and supporting papers. Prepare cash disbursement. The voucher packets are received by the cash disbursement clerk, who check them for the completeness and clerical accuracy. Update AP record. The AP clerk removes the liability by debiting the AP subsidiary account or by recording the check number and payment date in the voucher register upon receipt of the voucher package. Post to General Ledger. The journal voucher from cash disbursement and the account summary from accounts payable are given to General Ledger clerk.
These are control points in the expenditure cycle in summary in terms of purchases processing system and cash disbursement system. For transaction authorization in terms of purchases subsystem, the inventory control functions continually monitors inventory levels. As inventory levels drop to their predetermined order points, inventory control formally authorizes replenishment with the purchase requisition. And for cash disbursement subsystem, the AP function authorizes cash disbursement via cash disbursement voucher to provide effective control over the flow of cash from the firm. The cash disbursement function should not write checks without the explicit authorization, and for segregation of duties of purchasing subsystem, the primary physical asset is inventory. Inventory control keeps detailed record of the asset while the warehouse has custody. At any point, an auditor should be able to reconcile inventory records to the physical inventory. The asset subject to exposure in the cash disbursement subsystem is cash. The records controlling these assets are the AP subsidiary ledger and the cash account in the general ledger. An individual with the combined responsibility of writing checks, posting to the cash account, and maintaining AP could perpetrate or carry out fraud against the firm. For supervision, the area that most benefits from supervision are the receiving department. Large quantities of valuable assets flow through this area on their way to the warehouse. Close supervision here reduces the chances of two types of exposure. First is the failure to properly inspect the assets, and second one is the theft of assets. The control objective of accounting records is to maintain an audit trail. Audit trail is inadequate for tracing a transaction from its source document to the financial statements. The expenditure cycle employs the following accounting records: the AP subsidiary ledger, voucher register, check register, and general ledger. For access controls for direct access in the expenditure cycle, a firm must control access to physical assets such as cash and inventory. These control concerns are essentially the same as the revenue cycle. Direct access controls include blocks, alarms, and restricted access to areas that contain inventories and cash. In direct access, a firm must limit access to documents that control its physical assets. For example, an individual with access to purchase requisitions, purchase orders, and receiving reports has the ingredients to construct a fraudulent purchase transaction. For independent verification, by accounts payable, the AP function plays a vital role in the verification of the work others in the system have done. Copies of key source documents flow into this department for review and comparison. Each document contains unique facts about the purchase transaction, which the AP clerk must reconcile before the firm recognizes an obligation. And for independent verification by the General Ledger Department, the General Ledger function provides an important independent verification in the system. It receives journal vouchers and summary reports from inventory control, AP, and cash disbursements. For the next slide, we have two systems in expenditure cycle. First one is physical systems, review of manual procedures, and then moves on to deal with several forms of computer-based system. Second one is a manual system to support the conceptual treatment of system presented in the previous section. This should help you envision the relationship between organizational units, the segregation of duties, and the information flows essential to operations and effective internal control. For the next slide, inventory control when inventory is dropped to a predetermined order point. The clerk prepares a purchase requisition. One copy of the requisition is sent to the purchasing department. One copy is placed in the open purchase requisition file. And for last, for the control department, purchasing department receives the purchase requisition, then is sorted by the vendor and prepares a multi-part PO for each vendor. Receiving department, goods arriving from the vendor are reconciled with the blind copy of the PO. After physical count and inspection, receiving clerk prepares a multi-part receiving report stating the quantity and condition of the inventories. And for the AP department, invoices arrives, the AP clerk reconciles the financial information with the documents in the pending file. General Ledger Department receives a journal voucher from the AP departments and an account summary from Inventory Control. Reconciles these and posts to the Inventory and AP Control accounts. And for Cash Disbursement Department, the cash disbursement checks reconcile the checks with the transaction listing and submit the negotiable portion of the checks to management for signing. And for accounts payable, upon receipt of the check copies, the accounts payable clerk matches them with open vouchers and transfer these closed items to the closed voucher file. For the next reporter, may I call on Ms. Catherine Ocampo.
Computer-based purchases and cash disbursements applications automating purchases procedures using batch processing technology. Data Processing Department Step 1 begins in the Data Processing Department, where the inventory control function is performed when inventories are reduced by sales to customers or usage in production. The system determines if the affected items in the inventory subsidiary file have fallen to their order points. If so, a record is created in the Open Purchase Requisition file. The record contains the inventory item number, a description of the item, the quantity to be ordered, the standard unit price, and the vendor number of the primary supplier. At the end of the day, the system sorts the Open Purchase Requisition file by vendor number and consolidates multiple items from the same vendor onto a single requisition. Next, vendor mailing information is retrieved from the valid vendor file to produce hard copy purchase requisition documents, which go to the Purchasing Department. Purchasing Department. Upon receipt of the purchase requisition, the Purchasing Department prepares a multi-part PO. Copies are sent to the vendor AP, receiving data processing and the Purchasing Department's file. A computer program identifies inventory requirements and refers traditional purchases requisitions. But the purchasing agent reviews the requisitions before placing the order. Such manual intervention, however, does create a bottleneck and delays the ordering process. If sufficient computer controls are in place to prevent or detect purchasing errors, then more efficient ordering procedures can be implemented. Alternative approaches for authorizing and ordering inventories. Alternative approaches for authorizing and ordering inventories. Alternative 1. This system automatically prepares the PO documents and sends them to the Purchasing Department for review and signing. The purchasing agent mails the approved POs to the vendor and distribute copies to the other internal users. Number 2, Alternative 2, expedites the ordering process by distributing the POs directly to the vendor and internal users, thus by passing the Purchasing Department completely. Instead, the system produces a transaction list of items ordered for the purchasing agent's reviews. Alternative 3 represents an engineering technology called electronic data in charge. This method produces no physical POs. Instead, the computer systems of both the buying and selling companies are connected via a dedicated telecommunications link. The buyer and seller are parties to a trading partner arrangement, in which the entire ordering process is automated and implemented by human intervention. In each of the three alternatives, the tasks of authorizing and ordering are integrated within the computer system. Because physical purchase requisitions have no purpose in such a system, they are not produced, Digital requisition records, however, would still assist to provide an audit trail. Data Processing Department, Step 2. A copy of the POs is sent to data processing and used to create a record in an open PO file. The associated requisitions are then transferred from the open purchases requisition file to the closed purchase requisition file. Receiving Department. Receiving Department, when the goods arrive from vendors, the receiving clerk prepares a receiving report and sends copies to the stores with the goods purchasing AP and data processing. Data Processing Department, Step 3. The Data Processing Department creates the receiving report file from data provided by the receiving report documents. Then a batch program updates the inventory subsidiary file from the receiving report file. The program removes the on order flag from the updated inventory records and calculates batch totals of inventory receipts, which will later be used in the general ledger update procedure. Finally, the associated records in the open PO files are transferred to the closed PO file. Accounts payable. When the AP clerk receives the supplier's invoice, he or she reconciles it with the supporting documents that were previously placed in the AP pending file. The clerk then prepares a voucher, files it in the open voucher file, and sends a copy of the voucher to Data Processing. Data Processing Department, Step 4. The voucher file is created from the voucher documents. The next step is a batch program validates the voucher records against valid vendor file and add them to the voucher register, open AP subsidiary file. Finally, batch totals are prepared for subsequent posting to the AP control account in the general ledger.
An excellent morning to everyone. The next topic is the cash disbursements procedure. What is cash disbursements procedure? Cash disbursement is the outflow of cash paid in exchange for the provision of goods or services. A cash disbursement can also be made to return customers, which is recorded as a reduction of sales. Yet another type of cash disbursement is a dividend payment, which is recorded as a reduction in a corporate equity. Okay, here we have three types of the cash disbursement procedure per department. First is the data processing department. Here in the data processing department, data processing is generally the collection and manipulation of items of data to produce meaningful information. In this sense, it can be considered as subset information, processing, the change processing of information in any matter detectable by an observer. Next is the cash disbursement department, wherein the cash disbursement clerk reconciles the check within the transaction listing and submit the negotiable portion of the checks to management for signing. Here, the checks are then mailed to the suppliers. One copy of each check is sent to AP. Other copy is filed in cash disbursements along with the transaction setting. Okay. Next is the accounts payable department. Here, upon receipt of the check copies, the accounts payable clerk matches them with open vouchers and transfer this now closed item to the closed voucher files. Okay. Next slide is the re-engineering the purchases cash disbursement system. First is the data processing, but before that, the re-engineering the purchases. This is the rethinking and redesigning business processes that can be achieved dramatic improvements in a critical performance measures. Procurement process re-engineering is the analysis and the design of the procurement function of a business to mine hidden strategic value to bring about the dramatic improvements in performance. Okay, So again, in the data processing, we have the following tasks to be performed automatically. First is the inventory file, wherein to be searched for items that have fallen to their reorder point. Next is the record entered in the purchase requisition file for each item and to be replenished. Next is requisition are then consolidated according to vendor number. Next is the vendor mailing information is retrieved from the valid vendor file. Next is purchase order are prepared and added to the open purchase file. And lastly, a transaction listing of purchase orders is sent to the purchasing department for review. Okay? Next slides is the re-engineering the purchases in the receiving department. Okay, in the receiving departments, if when the goods arrive, the receiving clerk access the open purchase order file in real time by entering the purchase order number taken from the packing slip. Next is the data processing. This is mentioned a while ago, but in order for us to become more detailed, the data processing here is the conversion of data into a usable and desired form. This conversion or processing is carried out using a predefined sequence of operation either manually or automatically. Here we have the following tasks to be performed automatically by the system. First is the quantities of items received are matched against the open purchase order record, and a Y value is placed in a logical field to indicate the receipt of inventories. Next, a record is added to the receiving report file. Next, the inventory subsidiary record are updated to reflect receipt of the inventory items. And next, the general ledger inventory control account is to be updated. And lastly, the record is removed from the open purchase order file and added to the open accounts payable file, and a due date for payment is established.
The automated system improve inventory control. The greatest advantage of the automated system over its manual counterpart is improved ability to manage inventory needs. Inventory control monitors and records finished goods inventory levels. When inventories drop to a predetermined reorder point, a purchase requisition is prepared and sent to the prepare purchase order function to initiate the purchase process. In improving ability to manage inventory needs, inventory requirements are detected as they arise and are processed automatically. As a result, the risk of accumulating excessive inventory or of running out of stock are reduced. With this advantage, however, comes a controls concern. Errors or flawed inventory models can cause firms to find themselves suddenly inundated with inventories or desperately short of stock. In better cash management, the automated system promotes effective cash management by scanning the voucher file daily for items due, thus avoiding early payments and missed due dates. By writing checks automatically, the firms reduce labor costs, saves processing time, and promotes accuracy. To control against unauthorized payments, voucher file should be validated by comparing the vendor number on the voucher against the valid vendor file. A manager in the cash disbursements department physically signs the checks, thus providing control over the disbursement of cash. In time lag exists between the arrival of goods in the receiving department and recording inventory receipts in the inventory file. When sales clerks do not know the current status of inventory, sales may be lost. In purchasing bottleneck, The purchasing department is directly involved with all purchase decisions. For example, you ordered goods and services. Before you order the things you need for your business, you need to do some research. This part of the expenditure process might include checking out vendor reviews, asking for product samples, and comparing a variety of sources. You also want to be set up as an approved account after you choose a supplier. This must this might require you to apply for credit with the supplier. If you begin this process just before you're ready to order, your orders might be delayed, which can cause a supply chain bottleneck that affects your entire company. In receiving orders, make sure every order you receive from a supplier is acceptable as soon as it arrives. If you wait until it's time to start using your supplies and find problems with them, the delay can once again cause a significant bottleneck in your operations. And in excessive paper documents, the automated system is laden with paper documents. All operations department create documents which are sent to data processing and which data processing must then convert to magnetic media. Paper documents add because they must be purchased, stored, prepared, handled by internal mail carriers, and converted by data processing personnel. Organizations with high volumes of transactions benefit considerably from the reducing or eliminating paper documents in their systems. The re-engineered system. In control implication, this system removes the physical separation between authorization and transaction processing. Computer programs authorize and process POs as well as authorize and issue checks to vendors. The systems provide management with detailed transactions, listing, and summary reporting. Next, the segregation of duties. What is segregation of duties? The segregation of duties concept prohibits the assignment of responsibility to one person for the acquisition of assets, their custody, and the related record keeping. For example, one person can place an order to buy an asset, but a different person must record the transaction in the accounting records. By separating duties, it is much more difficult to commit fraud, since at least two people must work together to do so, which is far less likely than if one person is responsible for all aspects of an accounting transaction. These are examples of segregation of duties. Segregation of duties for cash. One person opens envelope containing checks, and another person records the checks in the accounting system. This reduces the risk that checks will be removed from the company and deposited into a person's own checking account. And second example is the segregation duties of accounts receivable. One person records cash received from customers and another person creates credit memos to the customers. This reduces the risk that an employee will divert an incoming payment from a customer and cover the theft with a matching credit to that customer's account. Accounting records and access controls maintains accounting records exclusively on magnetic disks to preserve the integrity of these records. Advanced systems maintain accounting records on digital storage media with little or no hard copy backup. Legislation requires organization management to implement adequate control security measures to protect accounting records from unauthorized access and destruction.